This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, at the end of our first lecture on groups, what I asked you to look at and consider before this current lecture was Chapter 12 and what a single company could do when it experienced its own losses. What you'll have seen from that, at least I hope what you've seen from that, is that the main loss that we ever have to deal with is, of course, trading losses, but there's a possibility of maybe some property business losses that might also arise there. But the normal one is trading loss. That's the big one. So what I want to do first of all is just run through a little example with you to make sure that you are fully proficient in terms of the normal single company reliefs. Now then, again, if you make a note of the information that you see there in front of you, we've got, of course, information provided within a question, as this would be, in a columnar basis. When we do our answer, we'd also provide that on a columnar basis if we're doing a written answer, of course, within section C of our paper. What we see here, we've got the years ended the 31st of March, 18, 19 and 20 there. Trading income figures coming in, whereas you'll see clearly for the year ended March 19, there is the key issue. We have a £200,000 trading loss. Prior to that period, we were profitable. In the next period, the year ended March 20, we are again profitable. We've got this one-off loss of £200,000. We have property income figures of various amounts through these three accounting periods. And of course, though property income and trading income may be a constant in terms of inclusion on a corporate tax computation, chargeable gains are rather more one-off. They'll only arise as and when we have a chargeable disposal that gives rise to a chargeable gain. So we can see here that there was a chargeable gain of just £5,000 in the year ended 31st of March 18, nothing in the year ended March 19, and gains of, again, net gains, I should probably more correctly say, of £15,000 in the year ended March 20. Across the board here in each of these three accounting periods for this company, the company has made qualifying charitable donations. That's what the QCD stands for there, qualifying charitable donations of £10,000. So, what loss reliefs would be available? Now again, not always, but a common requirement is for students to apply loss reliefs at the earliest available opportunity. So if this were a single company, and that instruction was given to apply loss reliefs at the earliest available opportunity, I'd like you now to consider what those reliefs would be. How much loss could be applied against how much profit in each of which accounting periods. Now again, pause at this particular point to allow yourself time to note this information down and proceed to perform that particular exercise. We have the loss of £200,000 there in the year ended March 19, and I want you to utilise that loss at the earliest available opportunity. So identify where and when and to what extent those loss or that loss may be used under the various reliefs. So again, pause at this particular point to allow yourself time to do that. Okay, well, let's see, therefore, how we have got on with this exercise. Now, what we should be aware is that the instruction is relief at the earliest available opportunity. What does that mean about the order in which we make those loss claims? It means, of course, that the first claim that we must make will be in the current period. What do we set off against? Well, what we set off against is what we set off against, whether it is the current period, whether it is the preceding period, we know we go then to a 12-month carry back, or whether it's carry forward. What you'd have identified on your answer page would be a figure subtotal of total profits. What you'd also know that for this, the loss-making period, the year ended March 19, that the assessment would be nil. Therefore, you'd be looking at total profits of £30,000. Nil trading income, 30,000 property income, nil chargeable gain, total profits 30. If we made no such claim, then we deduct the donations of 10, and that would come down to a TTP of some £20,000. But if we claim relief at the earliest available opportunity, what do we now do? We would go against the entirety of that total profit, with a current and indeed with a carryback claim, no partial claims. So the only loss relief available here in the current period is a full claim against the full total profits of 30. So 30,000 of our £200,000 loss there would go. So that would leave us with 170,000, which if we now choose, and given the instruction we will choose, to carry back. How far back do we go? 12 months. Well, as we'd expect in most circumstances, the last 12 months will of course be the immediate preceding chargeable accounting period, here the year ended March 18. What were its total profits? Well, we had 100,000 trading income, plus 10, plus 5, we got £115,000 of total profit. Do we have sufficient loss to offset all of that total profit? Yes, we do. We had started, you would of course put this in a working labelled loss memorandum, we started with our loss of 200,000. In the current period claim we used 30, leaving 170 to be carried back. More than sufficient to cover the 115. And what that means is that in both the current period and in the preceding period, we of course will have wasted our qualifying charitable donations. Now, we have no choice in the manner of claim. No partial claims are permitted for current and then carry back claims. So the £10,000 worth of charitable donations paid in both the year ended March 19 and in the year ended March 18 as a result of our current and carryback claims, those donations, those payments will have been wasted. There'll be nothing to deduct them from. What would then be left over? Well, we'd have used, as we have said, 30,000 in the current period, 115,000 in the previous period against the full total profits of each period. So that's £145,000 in total we would have used. That's the 30 plus the 115. 145 away from 200. Again, you'd have identified this in your loss memorandum working. That will leave you with 55,000 to go against the total profits of the year ended March 20. What do those total profits amount to? 90 plus 20 plus 15. So that's 90, 20, 110, 125,000. Well, of course, we've only got £55,000 of loss remaining. Therefore, the 55 would go against the 125. That taken away would leave us with, 70,000 remaining total profit. And that would be more than sufficient to cover the qualifying charitable donation. Now, that would be, again, there applying the loss relief at the earliest available opportunity. Now, the good news, as you know about doing that, is from a cash flow point of view. It means to begin with that we will not now have to pay any tax on what would have been a £30,000 profit of the current period, the year ended March 19, and we'll get a repayment. We won't have to pay any tax on the profit that would have been not 30, but of course it would have been 30 minus 10. It would have been £20,000 as the TTP. We've had to use £30,000 of loss, of course, to take out all of the total profit, but it would have saved us paying tax on £20,000 of TTP. That tax saving will be immediately achieved, and of course you'll get a repayment of the tax paid in relation to the previous year, the year ended March 18 there. Now that had total profits of 115, donations of 10, without any loss reliefs being applied, 10 from 115 would have been at 105. So without the carryback claim, I repeat, a claim that had to be £115,000 of loss relief applied, but we would otherwise have been paying tax on the £105,000. That tax by now would already have been paid, and therefore this claim will generate a repayment of that tax paid in relation to the previous year. But that cash flow benefit has come at a price. We have wasted £20,000 of qualifying charitable donations spread over those 2 accounting periods. So if instead we had chosen to carry forward, let's say, all of that loss of 200, what then would have happened? Well, have a think about that. If we were to carry forward the 200, we know it goes against future total profits, that is 125,000. Would we have the same problem of wasting those donations? Answer, no. Because when we carry forward now these losses, we are able to restrict that claim. On a carry forward, we are able to make a partial claim. We can claim to reduce the loss relief applied from what would have been the £125,000 figure there down to what instead would be, well, what claim would we like? 115. And that claim again would go against your total profit. 115 from 125 would bring you down to 115, and that means you would then have £10,000 of total profit against which you are able to offset the donations of £10,000. The balance of the loss as yet unused would again continue to be carried forward. The plus side of this, you are no longer wasting donations. The downside of this is, of course, there's no immediate benefit. You're going to have to wait until the tax would have become payable for those periods, which is then reduced or indeed eliminated in the case of the year ended March 20, before you actually get any tangible cash flow benefit. Okay, so have a little think about what we said there as regards our normal single company claims, and then come to these notes as regards our introduction. Have a little read through this first section of 4.1 just to begin with. I will take you through that, but before I take you through it, to better understand it, just have a little read through that, which will explain to you what amount of losses will be available to be group relieved, and will then explain the nature of that group relief. So pause now, therefore, while you read through, and then join us again so that we can discuss that together. Okay, so what have we discovered in that little note, that little introduction to group relief, therefore? As we knew from our original introduction, you've got to be in a 75% group. Now, we'll define that rather more specifically in a short while. Again, there's no problem in interpreting it when dealing with a direct subsidiary. The parent company owns 75% or more of the shares directly in its subsidiary. What we'll discover, of course, is that if you have indirect subs, as per the original group structure that we outlined up here, where we had both the direct as well as the indirect subs, we'll discover that 75% in terms of group relief is actually interpreted as effective 75%. But more of that in a short while. But once you've established which companies are able to group relieve with one another, what loss are you able to group relieve from, as we'll call him or her, the surrendering company? You are allowed to transfer any part, so we have flexibility as to how much loss is surrendered under group relief, any part of a current year trading loss of one such group company to set off against any part of another company's taxable total profit, the TTP. Another big difference there. The loss reliefs that we've seen so far, that we reminded you of a few minutes ago in relation there to a single company, they all go against total profits. And of course, the problem with where you had current and carry back claims and there were no partial claims was that you might end up wasting the qualifying charitable donations. Not an issue now in terms of group relief. Any part of a current period trading loss may be set against any part of the TTP of the claimant companies, the profit-making companies, TTP, of what we'll discover is a corresponding accounting period. Now, routinely you'd expect that companies within the same 75% group will all prepare accounts to the same date. So of course it would be a corresponding accounting period, comparing the profit of one period with the loss of another. But what may happen in exam questions, you may get what goes by the glorious title of non-coterminous accounting period ends, where it's just a technical question of how much of the loss-making period corresponds with how much of a profit-making period. And you have to time a portion accordingly. You have to match like with like. But don't worry, the note and examples on that are coming up just a little bit later. Now, the main figure that is ever available for group relief is, of course, the trading loss, as we've just defined. But it's not the only possible loss that may be used in a group relief claim. Group relief is also available here in respect of, notice the word here, excess. Excess qualifying charitable donations, and probably more likely, excess property business losses. Now again, we use the word here, such losses are only excess if they, you might know that word is going to come up again, exceed the total profits of the company concerned, and that is exceeding those total profits before you've applied any other losses. Before applying any other losses. What you have is the situation where the total profit figure before any other relief, loss relief has been applied, that figure is less than either the qualifying charitable donations to be deducted from them, or it is less than the property business loss, in which case you have an excess qualifying charitable donation, you have an excess property business loss. So only that excess over and above what are the total profits of this company for this period, only they, the excess figures, may be group relieved. When you deal with the trading loss, as we highlighted here, any part of a current year trading loss may be offset against any part of the claimant company's TTP. As we've already referenced in chapter 18, but the statements were made there, which hopefully again you have revised, that is, any unused trading losses or property business losses brought forward by a company may now also be surrendered as group relief. Now that again is a new issue. Before, you literally could only group relieve in the current period losses against the current period profits. Now, if we have either these trading or property business losses brought forward by a company, then they may, in the future, when brought forward, then be surrendered as group relief in that future period. But, and this is the restriction you'd have to note, and no doubt in any exam question would be tested, the bit that you can group relieve is only to the extent that the loss-making company is unable to set off the loss against its own total profits. So when that loss is brought forward within that company, the loss-making company, the only bit of it that may be able to be surrendered by the loss-making company to other group members in a group relief claim is an amount that exceeds any total profits of that company for that period. So you must use again, or you're deemed to have used firstly, any brought forward loss against that company's own total profits. Only if your loss brought forward exceeds that company's own total profits may the excess then be group relieved. And again, it is then your choice. Group relief is optional. You don't have to make it. You can choose to make it if you so desire. Now we'll look at those issues in relation to our earlier example. So if I can just get you to go back to the example here that we used when illustrating the basic single company reliefs, the current period claim, the carry back claim, the carry forward claim. Now let's look at what this means in the context of group relief. Now then, what have we got here? Here is our loss-making period. Right. Question. If this company is now within the 75% group as required for group relief to be available, how much loss in the year ended 31st of March 19, in this loss-making period, how much loss do you think may now be surrendered as group relief? What is the maximum amount of loss that may be surrendered in the form of a group relief claim? Go back and look at what we've just emphasised time after time. Any part of a current period trading loss is eligible for group relief. So there you go. It is all of that 200. The company does not firstly have to relieve its own loss against its own total profits of that period. Any part of a current period trading loss may be surrendered as part of a group relief claim to the claimant company. So 200 is available here. We've got, if we did surrender the 200, all of it could be surrendered as we've said. That would still leave, of course, property income of £30,000, less the donations of 10, it would leave a TTP of £20,000. So in this example, 200,000 is the amount of loss available for relief. But remember, of course, what we've said is that these claims are optional. You get to decide. Do you want to make a current period claim? Only, of course, if you have made current period, may you then make a carry-back claim. And when you carry forward within the company against total profits, you can choose to make partial claims. You can elect not to use some of the loss against some part of those total profits. In this question, therefore, this company with that loss of £200,000, let's assume that in the current period, we're not able to group relieve it. Maybe because there are insufficient profits. Maybe there are no profits available for group relief elsewhere within the group. And on that basis, therefore, we choose to carry the loss forward. Now again, that is notwithstanding, as we've already dealt with, the other options. We could set there against the total profits of the current period. If and only if we've done that, we can then go back against the total profits of the previous 12 months. But let's now assume that we carry it forward. What would now happen is that that loss carried forward, as we've already seen, would be eligible to go against any part of the total profits in the future. Now that future period, the year ended March 20, we've got 90 plus 20 plus 15, as no doubt you recall there, £125,000. What we realised, of course, is that we wouldn't make a full claim there because we'd want to make sure that we use up those donations, and on a carry forward we're entitled to do that. But if what you wanted to do was to now also group relieve, because remember, the new rules allow a brought forward loss. There, the 200 is being brought forward into the year ended March 20. But that loss can only be group relieved to the extent that the loss exceeds the total profits of that current period. There is your total profit of the current period, £125,000. So even if all of this 200,000 is brought forward, and irrespective of whatever claim, if any, that you make against those total profits, the maximum group relief possible that could be surrendered from this company for this period, year ended March 20, to any other group company would be the 200 loss brought forward less the potential current period claim of 125,000. So only 75,000 would be eligible for group relief. So let's just go back and look at what the note says, as we've stated there. Any unused, this was a trading loss, brought forward by a company, may now also be surrendered as group relief, but only to the extent that the loss-making company is unable to set off that loss against its own total profits. What are its own total profits? £125,000. So you've got a 200,000 loss. You're unable to offset 75,000 of that. That is the figure that would be available for group relief. Okay. Now, once we've established the amount of losses that are available to be group relieved, as we said, you've got to know with whom, with which other companies can you group relieve. And here we've got the definition of what we mean. For group relief purposes is a 75% group. Now, obviously, one company is the 75% sub or another, or both companies, co-subsidiaries, are 75% subsidiaries of a third company, the parent company. So any direct relationship between a parent company and direct subsidiaries, any of those companies are able to group relieve with one another. The holding company must own at least 75% of the share capital and entitled to at least 75% of the sub's assets on a winding up, and entitled to at least 75% of the subsidiary's profits on a distribution. There's our definition of a 75% group. Now, although that could be the object of a written question in terms of what are the provisions relevant, let's say written question, an objective testing written discursive question, which of these is or is not a condition for group relief to be available? Those are the three conditions that need to be satisfied to constitute a 75% group. But you're much more likely to have this rule tested in relation to indirect or sub-subsidiaries. What we've already said, and we've put it here in capitals, is that the holding company must have an effective interest in any sub-subsidiary, indirect sub, that is, of at least 75% for them to be in the same group for group relief purposes. For example, if a parent company owns 90% of the shares in a subsidiary, so we've got H owning 90% of S1, clearly those two companies can group relieve. We've got a direct and effective holding of at least 75%. If a parent company owns 90% of the shares in a subsidiary, which in turn owns 90% of its subsidiary, so S1 owns 90% of S2, then all three companies would be able to group relieve with one another, as the parent company has an effective 81% interest, i.e. 90% of 90%, there we go, 90% of 90, in the sub-subsidiary. The effective interest is 81, that is at least 75, so group relief is available. And it's separately noted later, once you've established which companies are in the effective 75% group, and group relief can flow in any direction. So either of those two subsidiaries could surrender a loss to one another and or to the holding company. The holding company could surrender its loss to either or both of its two subsidiary companies there. So the losses can flow in any direction. Holding company to sub, sub to holding, sub to sub, it doesn't matter. As long as they are bound within the same effective 75% group, all is well. But looking at that three-tier structure there, H to S1 to S2, if the subsidiary company, S1 in our example, owned only 80% of the shares in the sub-subsidiary, so instead of that being 90, that was 80, now you have a problem, because 90% of 80% will equal only 72%. That fails the 75% test. If that were the case, then the parent company may only group relieve with its direct subsidiary, i.e. S1, as its effective holding in the sub-subsidiary is only 72%. 90% of 80% is 72. The sub-subsidiary, of course, may still group relieve with the subsidiary company, its own parent. S2 is able to group relieve with S1. S1 is in the fortunate position that it can group relieve either with its own subsidiary S2 or with its parent company, holding company there. The only two companies that cannot group relieve with one another is at the top of this, the holding company, and at the bottom, S2, the sub-subsidiary, the indirect sub. So the subsidiary can only group relieve with the sub, but the subsidiary company is able to group relieve with either its parent or its own subsidiary, because it has direct links of at least 75% to its parent company and separately to its own subsidiary company, S2 there. Now you've got a little example here. Z plc is the holding company for a group of companies. The group structure is as follows. Now again, it's a rather odd group structure that we've got, very linear here as we go from one company down to another. And for the year end, you're told, for March 19, Z plc has a trading loss. State the companies to which Z plc may surrender its trading loss in the year ended 31st of March 19. So, again, very easy, but have a quick look at this. Z plc. Is Z plc able to group relieve with A Limited? Yes. The direct holding and the indirectly effective, they are both the same, 100%. Can Z plc group relieve then with B Limited? Well, 100% of 80% equals 80%. The effective holding is indeed, therefore, effective 80%. That satisfies the 75%. So yes, Z plc can group relieve any part of its loss against the claimant company's profits, company A, company B. What about company C, where we go again with 80%? So this time, the link from Z down to C, 100% times 80%, as we already know, from Z to A and A to B, then on to C, times 80%. Well, that, of course, equals 64%. So no, Z is not able to group relieve with C. Of course, C is in a position to group relieve with its own parent company. C Limited can group relieve with B Limited there. B Limited is in a group both with its parent and ultimate principal parent company, A Limited and Z plc, and it can also group relieve with C. But so far as the question is concerned, who can Z plc surrender its loss to? Can go to A, can go to B, cannot go to C. In relation to the note, again, just reiterating what I said a moment ago, trading losses may be surrendered to other companies in the group, which may then relieve the losses against their own TTPs, their taxable total profits. Any member company may surrender its losses to any other member of the group. As we said, it can be holding company to sub. It can be subsidiary, surrendered to holding company. It can be sub to sub. So it doesn't matter, as long as they're tied within, bound within the effective 75% group, any one of the companies may be the surrendering company, the company that surrenders its loss, to the claimant company, the company to which the loss is surrendered, i.e. the company claiming that group relief there. In relation to the surrendering company, the surrendering company may surrender as much of its trading loss as it wants to, so any part of the loss. It is not necessary to relieve a trading loss against its own income and gains first. With our little example that we had, the example here, we discovered that any or all of that 200,000 was eligible in the year ended March 19 to be group relieved. And so long as other relevant group members, 75% group members, had sufficient TTPs to absorb that amount of loss, you could, if you so chose, group relieve all of the loss. You did not have to firstly use that loss against its own other profits of £30,000. You could leave those where they were. So 200 was the amount of loss. Back to the note. The losses which may be surrendered are, as we already know, any amount of a current period trading loss, unrelieved qualifying charitable donations of the period, i.e. excess qualifying charitable donations, unrelieved, i.e. excess property business losses of the period. These two, only after you have offset those deductions against the other profits, the total profits of this company in this period, may any excess then be group relieved, if of course you so choose. But then we have something else, again a note that we made earlier, and a point that we illustrated again with our little example. If we've got unrelieved either trading, as it was, but also property business losses that are brought forward, these too are now able to be surrendered as group relief, but only to the extent that they cannot be set off against the surrendering company's own total profits. So only a loss brought forward, be it trading, be it property business losses, be it the combination of the two. It doesn't matter what mix there might be, any combination of the two. That total figure of such losses brought forward, the only amount of that may be group relieved when brought forward into a period later than the loss-making period itself, the only amount of such brought forward loss that is eligible for group relief is the amount by which the brought forward loss exceeds the current period total profits. Only that bit is then eligible to be group relieved. You'll have noticed there that we haven't mentioned capital losses. Capital losses are not eligible for group relief, but are dealt with separately under gains group membership. You may recall in the introduction to this chapter seeing that, as well as the 51% groups, where we spoke about related 51% group company issues, group VAT registration, and the availability of AIA, in relation to 75% groups, the note referenced both group relief of losses and gains groups, membership of a chargeable gains group. That's where we will see, under totally separate rules to the group relief rules that we're discussing now, what may happen when a company in the gains group has a capital loss and another company within the gains group has net gains. It's not group relief, it is something different, but it will allow an offset of one against the other, but that awaits us later. The claimant company, the relief, as we know, is taken against the TTP of the same period as the surrendering company's loss-making period there. Again, when you group relieve in the current period, it must be against a coterminous period. It must be coterminous. Group relief summary. The important points to remember about group relief are: losses can be group relieved against 100% of a 75% subs TTP, or conversely 100% of a subsidiary's loss can be group relieved. As soon as you have the 75% holding, whether it is then 75%, 100%, or anything in between doesn't matter. A 70% shareholding in a group company that has made a loss will allow access to all of those losses. We do not get what happens to be our percentage shareholding in that loss-making companies. We don't get that amount of the loss. Where you own 75% plus of the shareholding, you have access to 100% of the loss. All of it is available to you. It is not restricted to the percentage shareholding. Any amount of a current year trade in loss is available to be group relieved. Just one point there, it says and business property. Remember, as regards business property losses, it is only excess. Only those business property losses in the period that exceed the total profits of the period, only they are eligible for group relief as stated in the previous notes. Not only are you able to group relieve in the current period in which a loss is sustained, but also amounts are brought forward unused trading and business property losses that cannot be set off, they're not able to be set off in the surrendering company, may also be group relieved. As we have said, as we have witnessed in our example, to the extent that the losses brought forward exceed the total profits of the current period, then that excess is what is available to be group relieved. As we'll discover in our next session together, where the accounting periods of two group companies are different, an unlikely practical circumstance but eminently an exam scenario, then group relief will be restricted to the corresponding, or there's our fancy word, coterminous period. Let's try not to cross it out again, or coterminous period there. All that means that we've got to do is a bit of time apportionment. It ain't rocket science. So it's therefore necessary to time apportion both the loss-making period and the profit-making period to see how much matches with, how much of the loss-making period matches with which profit-making period or periods, given that they prepare accounts to different dates. We need to match those time apportion to calculate how much loss may be set against how much profit in each chargeable accounting period. In this particular syllabus at this level, more awaits you in advanced taxation. Only UK resident companies are eligible for group relief, though 2 UK resident subs of an overseas resident parent company, they would be able to group relieve with one another, though neither could group relieve with its overseas parent company. So again, it's the possibility of a little objective testing question where you get H Inc. that is overseas resident, and it's got UK company, and these are at least 75% shareholdings, the same rule. Then the 2 UK companies, if one makes a loss and one makes a profit, one is able to group relieve with another there. Not a problem. What neither can do, you can't surrender a loss from a UK company to an overseas company or vice versa. There are limitations to that statement that I've just made, but they are beyond our particular syllabus. We do not group relieve. And in fact, in reality, it is very unlikely that you'd be able to group relieve between an overseas company and a UK company. But as these 2 companies are both UK resident, and they are both within a 75%, the same 75% group, even though their parent company is non-UK resident, it doesn't matter. The 2 UK companies are able to group relieve. Okay, review through that therefore, and what we'll then move on to in our next session is what happens where we have either non-coterminous accounting periods, or maybe a new company comes along part way through the period, so it hasn't been a 75% group member for the entirety of that period. How then do we determine how much loss is available to be group relieved against how much profit? All that and more in our next session together.